China, tariffs and the US election trade. Welcome to Market Insight, I'm David Pollard. Those bits of financial markets that could feel the impact of a Donald Trump victory are moving again as the US presidential race tightens with less than 3 weeks until election day. Today, though, the headlines belong to China. Data shows its economy grew at the slowest pace since early 2023 in the third quarter. At the same time, the PBOC has announced yet more stimulus. Investors are cautious over the detail and scope of other stimulus measures already announced. I'm joined now by Arun Sai, Senior Multi Asset Strategist at Pictet Asset Management. Welcome. China first. Today's data did beat forecasts, and the PBOC is now offering over $100 billion worth of swaps and relending schemes to support capital markets. How does this play with what seems to be your quite upbeat view on China?
Sure. So thanks for having me. And as you said, it's when it comes to investing in China, being on the right side of the policy cycle matters. And we look at it in three ways: intent, size, and follow through. There very clearly is intent from leadership in drawing a line, not just on the cyclical weakness, but also targeted at the right areas, from local government debt to property market. When it comes to size, we are encouraged by what we have heard so far, both from the monetary policy side. On the fiscal stimulus side, there seems to be a wide range of expectations. We'll have more clarity in a few weeks. But by and large, we think this represents a big shift from tinkering around the edges into something more resolute. And finally, on follow through, we think it's still a bit too early to look at traction and real results. But what again encourages us is that we are seeing signs of, for instance, retail sales numbers were slightly better than expected. And as you mentioned, the PBOC today, following up from their announcement a few weeks ago, already kickstarted their swap and the relending programs to support the equity market. So by and large, putting all of that together, we think this is a clear policy upswing, and Chinese equities can benefit from this further.
But pitching ahead is the possibility of US-led tariffs should Donald Trump get back into the White House. How dangerous could that be for asset markets, and what sectors would be likely to take the biggest hits?
Absolutely. So first of all, back to China on that. I mean, that's why it's important to keep in mind that China is not a cheap market at 11 or 12 times PE. So a part of the reason why we think that the current valuations is, if anything, in line with our fair value estimate, is because it compensates for the risk of the market not being very transparent at times, but also for the risk of continued trade friction with the US. So in a way, this is a risk which is very well flagged for China, and for us, that the primary source of returns from here, the primary driver, would remain policy momentum and follow through rather than risks from tariffs. That said, where we think risks are not fully priced in is, if anything, on global bonds. Because if you look at the potential outcome from the US elections, and we think it's important to think of the Congress as well, and not just a binary outcome, because that's where the real policy delta opens up between the clean sweep scenarios. And we think what the clearest asset class level implication is that Trump's policies focused around immigration and focused around tariffs is very clearly inflationary. And of course, that's negative for bonds. And we don't think that is adequately priced in. US Treasuries, for instance, we think fair value is around 4. We would have been tempted at 4.1 today to start kind of adding to our long duration positions, especially on Treasuries. But given this risk, a very clear risk of a red sweep outcome in a few weeks, we have to be more cautious on that front. So if anything, on a red sweep outcome, we think US 10-year bond yields could be as high as between 4.5% to 5%. So that's a clear risk.
So Arun, just to continue that thought, assets from small cap stocks to Bitcoin have been on the up, and the dollar looks set for a third weekly gain in a row as opinion polls do swing in Trump's favour. So should we bet on more such gains, and who would be the winners if Kamala Harris were to take the White House?
Right. So first of all, I think it's important to keep in mind that election outcomes don't leave a lasting imprint on the cycle. 2016 was an exception, but today the policy delta is much lower, and also the fiscal headroom is very limited. That said, in a 2 to 3 month horizon, there are very clear implications. At an asset class level, it's clearly bonds are more vulnerable for a Trump presidency, but at a more granular level, we would in fact push back against the muscle memory take that Trump is perhaps good for riskier assets, because we don't quite think that we would be able to repeat the tax cuts from last time. And also, if you look at the TCJA extension, that's pretty much priced in. And also, on the other hand, you're going to see increased not just geopolitical, but also trade policy uncertainty, which would keep multiples under pressure. So if anything, we think a Harris presidency, a divided presidency with Republicans retaining or taking control of the Senate, is the most equity positive, and even that is only a mild positive. Getting to more granular trades, as you said, there are clear implications again. A Trump presidency would be good for value, good for small cap, and generally good for US equities versus the rest of the world. And Harris presidency, we think the clearest implication of that is that it lets us be a little bit more constructive, more cyclical when it comes to emerging market assets, and also sectors like semis, autos, cap goods, where the policy priority from an industrial policy point of view becomes clearer.
Okay, we'll leave it there. Arun Sai of Pictet Asset Management, many thanks for sharing your thoughts with us today. That is your Market Insight. You can watch more videos on Reuters.com.